Today we're covering life insurance products for the Series 65 exam. The exam requires you to differentiate between the four main types of life insurance: term, whole, universal, and variable, and to determine their suitability for different clients. Let's start with term life. Term life provides a death benefit for a specified period, like 10 or 20 years, and has no cash value. For the exam, know that term life is suitable for temporary needs, such as protecting a mortgage or providing for young children. Its primary advantage is its low premium, making it the most affordable option. Next is whole life insurance. This is permanent insurance, meaning it covers you for your entire life as long as premiums are paid. The key features to remember for the test are its fixed premiums, a guaranteed minimum death benefit, and a guaranteed cash value that grows at a fixed rate. The insurance company places these funds in its general account and bears all the investment risk. Whole life is suitable for clients seeking a permanent death benefit with conservative, guaranteed cash value growth. Now, let's look at universal life. Like whole life, it's a form of permanent insurance. The critical distinction for the Series 65 is its flexible premiums and death benefits. The policy owner can adjust the premium payments and the death benefit amount. This flexibility is a major testable point. However, a common exam trap is a scenario where insufficient premiums are paid, causing the policy to lapse. The cash value in a universal life policy earns interest based on current market rates, not a fixed guarantee like whole life. Finally, we have variable life insurance, which is the only type considered a security. This means it requires a prospectus and must be sold with an insurance license and a securities license. The cash value is invested in a separate account, which functions like a family of mutual funds. The policy owner chooses the sub-accounts and therefore bears the investment risk. While there's a minimum guaranteed death benefit, the cash value is not guaranteed and can fluctuate with market performance. Variable life is suitable for clients with a long time horizon who want the potential for higher cash value growth to combat inflation and are willing to accept market risk. A common point of confusion on the exam is between variable life and variable universal life. Remember, standard variable life has a fixed premium, while variable universal life combines the investment features of variable life with the flexible premiums of universal life. The exam will test your knowledge of cash value. It's the savings component of a permanent life policy. Loans can be taken against the cash value, and if not repaid, they will reduce the death benefit. The growth of cash value is tax-deferred. You also must understand Section 1035 exchanges. This is a tax-free exchange of one insurance policy for another of a like kind. The exam will test the rules. You can exchange a life insurance policy for another life insurance policy or for an annuity. However, a common trap question involves an investor trying to exchange an annuity for a life insurance policy, which is not permitted. For the exchange to be tax-free, the funds must be transferred directly from one insurance company to another. To remember these, use this phrase: term is temporary, whole is for your whole life with guarantees. Universal gives you a universe of flexibility, and variable's value varies with the market. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.